markets. Let's straight away get to our first conversation on the show this morning. Steve Brice, Chief Investment Officer at Standard Chartered Wealth Management, is with us now. Steve, great to have you with us on the show. Thank you so much for joining in. So it's the end of the financial year for us here in India, end of what has been a good quarter in the US as well for equity markets. Let's start with the global setup right now. It's been a dream run. Do you see it continuing when we talk about the way a lot of the US indices have been surging?
So yes, we still see that the equity market outlook looks pretty robust. So we're continuing to feel that investors should sail with the wind in terms of staying invested in equity markets around the world, just generally speaking. So we're seeing earnings coming through this year. Obviously, we're seeing the likelihood that we'll see easier monetary policies coming through as well. So the US is one of our favored markets, and obviously that's outperformed so far this year. And we think that, given its sensitivity to the tech area and to communication services, which are more resilient to any slowdown in growth and more benefit more from lower interest rates, then the US should continue to do well in the coming months.
Steve, wanted to get your view on the Fed and what Christopher Waller had to say yesterday, but just let me put it on board for all our viewers because he did sound hawkish. Christopher Waller, in a speech at the Economic Club of New York, said, and I quote, "There is no rush to cut the policy rate. The recent data tells me that it is prudent to hold this rate at the current restrictive stance, perhaps for longer than previously thought, to help keep inflation on a sustainable trajectory towards 2%. It is appropriate to reduce the overall number of rate cuts or push them further into the future in response to the recent data." He's talking about the disappointing inflation data that came out recently. That said, he did say rate cuts are not off the table. Perhaps it will take place sometime this year. Steve, do you want to comment on these statements that Christopher Wallace said, and does it change your assessment of what we are likely to hear and see from the Fed this year?
Quite interesting, right? Because obviously it comes pretty close after the FOMC decision last week. And we had been sort of thinking that maybe the Fed might scale back a little bit on its rate cut trajectory, maybe to 2 rate cuts rather than 3. But they doubled down on that. So these comments sort of almost go back to where we thought we might be, but obviously very different trajectory and obviously a very different speaker. So something to watch out for. Obviously, if inflation continues to surprise on the upside, and we have been adding portfolio inflation hedges into our portfolios since January. If we did see further upside inflation surprises, then that would discourage the Fed from easing policies. He did mention, obviously, that if economic data was to weaken more than expected, then that obviously changes the picture for them. But it's certainly something to keep an eye on. The next inflation print is obviously going to be really, really important.
All right. Hi, Steve. Good morning. Good to see you. Now, I wanted to ask you about this recent rally that we're seeing in the Chinese markets. From bombed out levels, mind you, it's been the big underperforming market in the last few years, but it's not being backed by good economic data. The economic data is still pretty much mixed out there. How do you weigh these two? India, a market, a structurally good story, but China, at these valuations, maybe it's attracting some flows or some interest. Your view on the emerging markets and between India and China?
I think what we saw, about 6 weeks ago was extreme pessimism on the Chinese market. And obviously, we saw quite a lot of activity, both on the policy side in terms of macro policies, some stimulus coming in. And we have seen some stabilization in the data in recent times, which has led to people being less concerned about a debt deflation spiral coming to pass. So you have those two factors coming together, and obviously extreme valuations as well, extremely cheap in China's instance, to lead to a short-term bounce. Our view is that this is not necessarily something that we can see some short-term momentum. So we could see another 10% upside, for instance, in the China market in the short term. But this is not worth a structural overweight or a 12-month overweight until we get much more comfort that the economic situation looks stable and that we will actually avoid that deflationary slump. In terms of India, obviously, as you say, very positive story, but much more expensive valuation. We have a buy recommendation on the Indian market. But we favor large cap over small cap and mid cap at the moment. So that's our preference in that space. And we think that's largely, we see the valuations as being near peak valuations in the small and mid cap. But the large cap, obviously, slightly expensive, but not at cyclical peaks yet. So we feel that earnings are more resilient in that sector as well, as that part of the market. So So that's our view and relative view both between China and India.
So, and India is the top emerging market pick?
So we like India. We also like Korea. So Korea is quite a cheap area, but obviously very exposed to the semiconductor story. So those are the top picks that we have in Asia, Japan.
Got it.
Steve, what will Japan mean for just the flow of money in the coming few months and quarters? Because there are pretty historic things playing out over there, right? The possible end of yield curve control, end of negative interest rates, and a booming equity market. How have you sized up what's going on? What kind of exposure do you have? And generally, what does it mean for trade flows, for money flows into other emerging markets?
Yeah, so obviously from a Japan perspective, we're overweight as well, and it's obviously been a top performing market, even in dollar terms. So a lot of people obviously focus on the yen performance, but even if you strip out the yen weakness, we've seen still outperformance in dollar terms, even relative to the US. So we think this is a multi-year story for Japan. The only thing that sort of pulls me back a little bit, there is, if you look at the MSCI Japan index in dollar terms, it does look like there might be a double top formation. So we could see some short-term pullback. Obviously, we've got volatility coming through in the FX market and some commentary coming through from the authorities on that perspective. But ultimately, we'd expect to break some new highs. In terms of impact for other areas in Asia or around the emerging market world, we're not too concerned about that. To be honest, we think that the Japan market is a very specific story. So yes, we're going to see more flows going into Japan, but it's probably at the margin. I think the key story here is actually Japanese investors focusing more on the domestic equity market story, and we're seeing signs of that to some degree. But that's the real deal. If we start seeing flows from bonds in Japan into Japanese equities, then I think the authorities have achieved a big victory.
Okay, got it. So I guess, from our perspective, from what you say, we don't have to worry too much about flows, going into Japan, being pulled away from a market like India. That's not the story. I think it's more domestic investors believing in this big equity move that we're seeing in Japan. Got it. Steve, thank you very much for being with us. Great perspective. Really appreciate you being with us on the show, and have a great long weekend as well. We'll take a quick break on that note, come back on the other side, and our list of top stocks lined up, everything that you need to watch out in terms of the micro stock action today.